Yeah, so Blue Owl is an alternative asset manager. It's a relatively new kid on the block in alternative credit and in private capital. Primarily focused on credit, but it's got a varied ecosystem. Credit is about half the business. They're also involved in real estate and general partner stakes business. The principals of Blue Owl have been on the street a long time. They're very well known, and the principals have terrific reputations.
They have good reputations, but the company itself has kind of become a poster child for all the private credit concerns that have been hitting this market. How much of that is fair?
Yeah, so I think that there is a buildup for lack of a better term, fumes in the private credit world. Maybe it started off with a couple of high-profile bankruptcies last year. Jamie Dimon talking about cockroaches in the direct lending private credit world, which is somewhat ironic because many of these cockroaches happen to be on bank balance sheets rather than alternative asset management balance sheets, but cockroaches nonetheless. And then it just sort of continued to build. Then you had fear over AI's impact on software. Firms like Blue Owl tend to have a significant presence there. And the spark that sort of lit things on fire here was Blue Owl back in January was attempting to merge two of its entities together. That deal was scuttled. And in the process, they ended up selling some assets near par that they used to help redeem some of the capital for investors that wanted out. And that just sort of set off a bit of a firestorm.
Doug Ostrover, the co-founder. I know that guy from First Boston back in the day. Mm-hmm. Wow, good for him.
Yep.
So what's this stock to do? Is this just a company that's just got to put its head down, put up 3 or 4 quarters of solid earnings and then kind of earn its way back into the marketplace?
Yeah, I think it's telling that in the first quarter, despite all the sort of hand-wringing that went on, they managed to draw $11 billion of new capital in to support their funds. They had double-digit growth on a year-over-year basis. And I think that, basically what they need to do is just go about their knitting. They're asset managers, and if they can continue to put up good numbers, which they've been doing, generally double-digit returns in their funds above benchmark levels, then I think that investors will probably stay with them. I think that what we saw in the first quarter is maybe some of the hotter money, some of the investors, particularly in private BDCs, that may not have read their offering circulars.
It's right on the front page.
Or read it and don't care.
Yeah, or were texting while they were, while the risks were being explained. I think that they hit the panic button. By and large, most investors stuck with them.
Who are these investors who were seeking redemptions beyond the 5% that they're allowed to? I mean, what do we know about how sophisticated these investors are? Were they just putting in the request just to see if they could get it?
Yeah, I think it's probably a fairly wide net. If you sort of think in terms of the gatekeepers here might be the financial advisors. They tend to be a little bit more sober. Some of the investors, which includes an international cadre of holders, I think may have been the first ones to sort of push the eject button here. But it's a wide range of generally high net worth individuals that are investing in non-publicly traded business development companies.